Well, good afternoon. Good afternoon and welcome to another of our CSU Bakersfield Small Business Development Center's Webinar Wednesday. This is episode number 279. Thank you for joining us. Got a great show today. Good afternoon. I'm Kelly Bearden. I'm the director of the SBDC. We're located in downtown Bakersfield. So getting on, we got a great show today, a couple of fantastic guests. Let me tell you a little bit about the SBDC program. Coming up on Webinar Wednesday, next week, it's going to be all about pricing strategies. And I know you're going to hear me next week talk about if you tell me one more time you raised your price 10% because your costs went up 10%, you need to listen to Sean Palmer. So Sean will be in next week. Following that, we will have the queen of crowdfunding, Ruth Hedges. And Ruth's got a new program, I believe, called Rise Crowdfunding, and we'll get more information on that from her on the 21st. And then on the 28th, our very own Celeste Young Ramos, talking about the food and beverage program that actually will allow people to access the city grant program that is kicking off in July. About $1.5 million going out to businesses in certain qualified census tracts. We'll be talking about that on June the 28th. And again on July 12th, the other two providers beyond CSUB's extended education and SBDC will be the Launchpad, and it'll be T. Johnson and Nick Hill, Nick being from the Black Chamber of Commerce of Kern County. So they will be joining us to talk about that city grant program more. We will be taking a little bit of a holiday. We finally get a holiday around here. And we're getting Independence Day. So we are taking Independence Day. Not very likely that Maureen or I are going to be in here working on the webinar on Tuesday, July 4th. So everybody enjoy the 4th of July. And until then, what is up today, June the 7th, 2023? Well, today we're going to be talking about selling, buying, or even transitioning. There's a lot of different ways to do it. Your business, and maybe looking for new owners, or maybe even acquiring one yourself. So that is going to be today's focus. Michael Balstad is back joining us, and we'll get him in here in a little bit. Our resident economist, Dr. Mark Evans, checks in today. Dr. Evans is checking in with us as our Webinar Wednesday resident economist. And we will find out what he's got to say today. Capital Quarter continues. We started a little bit on the debt ceiling last week because we realized small businesses have a debt ceiling too. And what are some of those barriers creating that debt ceiling for your small business? What are some of those pitfalls out there if you are looking to capitalize your business? So we have another one of those to jump through in 5 slides or less today. Also, disaster relief continues to wind down. We'll give you a very quick update on that. And we continue to hope it continues to wind down. And the nice spring weather is really helping. Our SBDC toolbox will highlight the Clayton Leadership Transition Plan, really the homeowner, the generational changing leadership of the Clayton family. Morgan Clayton passing on control of the business to his children, and CEO to Tasha Clayton, and the plan that they used. And they used a very orchestrated plan. The template of that plan is available from the SBDC. So if you're looking to pass on your business, you're looking for generational change or other instances, do contact the SBDC. In our toolbox, we do have that. And as always, we'll take your questions. If you have an economics question or a question related to Dr. Evans, we'll check that after he presents, and then also after Mr. Balstad as well. So we'll always take your questions. Please add those to the Q&A section. Our webinar producer, Maureen Busher-Dang, will be working the chat box with a lot of resources that are available and other things to keep the webinar running smooth. And first, one very simple poll question. So our poll question for today is going to be basically very simple poll question. And it is going to be not opening. So, okay, the first glitch. Had a little bit of a issue last week and have a little bit of a newer system. Thought it was time and tested, but it is not allowing me to actually do the poll question. Let me try one more time because I am stubborn. And there it is. Thank you. Our poll question today is on economics. And so essentially the 3-month US Treasury bill that yielded 0.1% just 2 years ago. Yes, that is 0.1% 2 years ago, are expected to sell soon. What is the rate going to be? Is it going to be 3%, 6%, or 9%? So we're looking at the expected T-bill rate, the yield on a T-bill that is going to be sold soon by the US Treasury. Before, it was 0.1%. So literally, if you times that rate by 10, you got to 1%. Now it's going to be either 3, 6, or 9. Put in your choice, please. And we do have 46% of you already in. So last chance to guess. No whimsical question today. Last week, the Oscar Mayer Wienermobile broke the bank as far as popularity. So this week, we're just sticking with simple, our economic corner, and it is the 3-bill Treasury rate. What is it going to be? We are going to end the poll with 76% of you reporting and share the results. And the results have 52% of you saying 6%, which is correct. So from literally 0.1% to 6% in literally 2 years, that really has got to create some economic upheaval somehow. 43% of you went with 3%, not a bad guess, and 4%, 9%. So, and literally it could be 3 or 9% when we're talking about this in the months upcoming. So stay tuned. Thank you for participating for our poll question for today. And let's move on. Okay. So we talked a little bit last week about our debt ceiling for small business. What a great opportunity that Congress and the executive branch gave us to talk about debt ceiling. We don't want to talk about the government debt ceiling. We want to talk about the debt ceiling that is barriers to your small business. So last week, we talked about the debt to equity ratio. And the debt to equity ratio is calculated, and actually, if you just miss out on that ratio, that could be a very simple reason for you to be turned down. Doesn't matter what the rest of your loan package looks like. If your debt to equity isn't in line with your industry, you can be turned down. So this week, we're going to talk about a limited resource that a lot of people, I think, aren't totally familiar with, and that is the FICO Liquid Score. And the Liquid Score is a business credit reporting score. It's not based on the FICO system for personal credit and consumer credit that goes to 850 points. This one is one that goes from 0 to 300, and we'll talk about it in just a minute. And next week, we'll be back with another potential capital bear for your business, keeping you from that ceiling. So there was your debt to equity ratio from last week, and that was definitely an issue. So let's talk just briefly before we bring in Dr. Evans on the FICO Liquid Credit Score. So the FICO Liquid Credit Score is basically a little bit about how you manage your business, how your business and your personal credit is. So it does look at your personal credit history, your business credit history, and financial statements and other information on your business. Again, we do calculate it, or it is calculated between 0 and 300 points. Factors are going to include, like your other credit, your consumer credit score, how you pay your bills, how much debt you have, the types of credit extended to both you and your business. Some of the other factors, along with financial history of your business and cash flow management, are also considered. So as with your regular FICO consumer score, the FICO SBSS score, as it's called, the higher the better. If you were to apply for an SBA 7A loan, the bellwether guaranteed loan of the Small Business Administration, those loans are almost always pre-screened. And if applicants do not score over at least 155 points, then there is a manual process that they need to go through. So there could be extenuating circumstances on why they don't receive 155. There could be errors in there. There could be other things. But the 155, at least for SBA lending, is the number that we have seen thrown around at the SBDC here. So on your debt ceiling is, how is it calculated? Again, it goes back to your personal credit. but it also considers the personal credit of any business owners up to 5 owners. So if you have an S corporation or an LLC and you have 5 individuals that own 20% each, everybody's actual personal credit will be considered and calculated into that liquid score. So it also takes into consideration your business credit history, your number of employees, how long you've been in business, and also your financial statements. So the thing that's interesting, of course, like they keep very secret what is in your FICO score. Your FICO Liquid Score is also kept secret. And we'll continue to try to crack the code on how that is actually calculated. But one thing that might keep you from reaching your full potential as a business is actually that credit score, and that can be a debt ceiling for your business. Okay, it's economic corner time, and it's time for us to bring in our resident economist, Dr. Mark Evans. Dr. Evans doesn't get the full introduction as a resident economist anymore, but he did work for 4 decades as a faculty member of the economics department at CSU Bakersfield, among other things. And Dr. Evans, share your thoughts on whatever you want to talk about today.
Hello, everyone. Thanks for tuning in. It's been a rough week for Bitwise Industries. If you're in Bakersfield, Fresno, or Merced, you realize that Bitwise really was an important anchor in terms of downtown health. So I thought I would talk a little bit about that this week, give my thoughts in terms of what Bitwise's problems imply, both in terms of downtown health, but also broader regional economic development. Okay, Bitwise, on the surface, and potentially, it's really a match made in heaven for local government. What local government's interested in is the viability and vitality of their central business districts. And then local government plays a role in terms of regional economic development, both in terms of making development happen and in terms of ensuring that there's inclusive access to the improving economic outcomes. Bitwise's mission statement really addresses both of these local government goals. What Bitwise is involved in, as you know, is real estate investment anchoring downtown central business districts, workforce training that really is geared at diverse populations. So basically developing a representative workforce, and then this trained workforce then is to lead to sustained job creation, both internal and external to Bitwise. So, sounds good. It sounds good to a lot of cities. Their regional footprint is now the 3 cities in the Central Valley. I mentioned Fresno, Bakersfield, and Merced, but also 7 other metropolitan areas throughout the United States. Well, it's been a rough year for Bitwise. Here there's some bullets here representing all the challenges they seem to be facing, overdue payables, buildings on the market, reportedly failed attempts to secure high interest loans, a civil lawsuit, their employees being furloughed, and CEOs being fired and replaced. So I think that the gist of this is we really have to seriously contemplate the idea that they might not be back. It may be that the interim CEO, that the problems are just too severe to right the ship. So if that's the case, what are the implications in terms of downtown development and region-wide broad economic development? Well, to consider what the effects are in terms of broader economic development, I like to look at the report that Brookings Institution recently published for Kern County called the B3K Market Assessment. And to quote this study, tech-driven growth in the region, even at mid-skill levels, likely has been curtailed by digital skills proficiency. What Brookings found is that for mid-tech positions, there's roughly 760 job postings per year in Kern County alone, and 4 out of 5 of these positions go unfilled after a month. For high-tech positions, there were 6,700 postings per year, unique job postings. 1 in 10 was filled, so 9 out of 10 were basically unfilled after a month. So there is really a demand for these tech positions, both mid-tech and high-tech, and it's a demand that we're having trouble filling. So what I did on this slide is Bitwise was offering some really nice courses that we're providing access to citizens throughout our city. But if you look at the left side, these are the skills identified by Brookings as really being severely constrained in Bakersfield, and we're not much different than the other Central Valley cities in this regard. Mid-skills, computer systems analysts, network architects, et cetera. High skill positions that are sorely needed, software engineers, system and network administrators, things dealing with information security. Many of these things require a formal certification. Brookings listed the major ones. And then on the right, in terms of what Bitwise was providing, it was really pretty entry level knowledge and skills relating to coding and website development. So given that, I think what the likely impacts are, well, if you have a business that a lion's share of your customers are in downtown areas, it could possibly create significant challenges if they don't come back. In terms of the city's goals of just a vibrant downtown, it's going to be a setback. But in terms of broad regional economic development, I think it's minimal impact because the types of training that Bitwise was providing is different than the types of training that the Brookings Institution identified as really being the key to really better economic futures for us. So with that, those are my thoughts. The B3K report is really very thorough, and I mean, they've looked at our county with a fine-tooth comb in terms of everything that's relevant to our future economic development. And there's some things in there, and I think it's real important that we not do like often is done with one of these reports that we pay a lot of money for, stick it on the shelf, and then it collects dust. But this still is, I think, an area that we need to address. And we need to look at it closely because not all tech is the same in terms of what we need.
Okay, fantastic stuff. Thank you, Doctor. I can definitely see your connection to 3 of those cities that have been impacted by Bitwise furlough or recent hard times. Your connections with Buffalo, Las Cruces, and Bakersfield are significant. So they had an amazing footprint in areas that you are really familiar with and really adapted to. Okay, so quickly, we still have the SBA disaster loans, and the disaster filings are still open. Mother Nature's being very kind to us. Continue that, Mom. We still have disaster resource centers open in Mono County in the Bridgeport and Mammoth Lakes area. Both of those areas are open, and I don't know how much longer they're going to stay open, but we will check on that and report back to you next week. But a comprehensive list of resources that are there, both state, federal, and local. We did mention our Clayton Leadership Transition Plan if you're interested in our toolbox. You can check this YouTube video out, or this video on our YouTube with all of our other webinar Wednesdays. So feel free to go to the CSUB YouTube channel for this and many other types of webinars on buying, selling a business, franchising a business, or even transitioning like we did with the Claytons earlier. Okay. Other resource that we have is the HR hotline, and that is available. And looks like I'm running into some technical issues here. So what I'm going to do is I'm going to throw it over right now to Michael Balstad. And Michael Balstad, he's the founder of Harvest Transition Solutions, a firm specializing in exit strategies for small businesses. And those that are wanting to buy and sell. A certified exits planner. He's going to discuss a lot of the smooth retirement that's down the road for some of you small business owners and potentially another phase of your business life. So Michael works with buyers, sellers, and all. Planning is a key. I know he's going to tell me that. Michael Balstad, great to have you on today. Take it away, please.
Hey, thank you so much, Kelly. Great to see you again. Allow me to share my screen here. Hopefully everyone can see it. Great to see everybody today, and what a timely presentation by the good doctor a few moments ago in talking about economic development. And this is something that is very present as we look at why my role has become quite in demand the last several years. So what we're going to be talking about today is selling your business, some things to consider. And we'll talk about selling broadly because most people think about getting out of business as selling, but a sale transaction for value is not always the strategy that makes the most sense, depending on the outcome that the current owner and steward of that business, what their objectives are. Oops, back up. So as Kelly mentioned, my name is Michael Balstad. I'm a certified exit planning advisor. Founded Harvest Transition Solutions a few years back, and primarily working with a lot of the SBDCs through the pandemic. During that period, really wasn't working with my individual clients, which are usually in the lower middle market size companies, kind of the $2 to $20 million area. There was such a need in the small business community and going through the pandemic and just keeping the doors open that I found that in my first year of business, actually, when I started this, it really made the most sense to be available to small business owners like my late father-in-law, who his business had died a preventable death 20 years ago, which is what got me into this in the first place. So I'm a regional advisor to the Northern California SBDC, which is separate from the Central California SBDC that I'm visiting with you on today. I'm an advisory council member to Project Equity, which is a nonprofit organization focused on expanding the role of employee ownership in business transitions. I'm also a member of the National Center for Employee Ownership. You'll notice a bit of a theme there as we're talking through this, that I do a lot with employee ownership. I've been working with small companies for a little over 20 years. So, and actually, I'm having a little bit of problem here myself. So what's the market right now for selling a business? I want to go back to what the doctor was talking about earlier with what the economy is looking like. And we were talking about the debt ceilings. There are a number of issues that are affecting the marketplace for the purchase and sale of businesses right now. A big piece of it is we just look at it as uncertainty. You know, a lot of folks wanted to get out of their business during the pandemic due to burnout, due to, just the pressures on mental health and financial health. Likewise, when we started getting into this recovery phase, then, with some economic policy issues and things, we started seeing, rampant inflation. It caused interest rates to go up. And as you saw on the T-bills, they're projecting a 60-fold increase over the last 2 years on the rates for 3-month debt. So when you consider the costs of borrowing now versus 2 or 3 years ago, it makes what someone can afford to borrow for the same money much less. And when someone is looking at purchasing a business, there's part of it that's going to be based on what they have liquid as a contribution for a down payment. But the ability to pay the ongoing note is going to be based on the payment making ability of the business in question. So really, what is the cash flow available to service the debt? And the lenders are going to be looking at not just, is there enough net cash flow, but is there enough net cash flow while still allowing the owner to pay themselves? Is it worthwhile for that owner to not walk away from the business? So the bank is really looking at mitigating risk and wanting to make sure that the person that they're lending that money to acquire the business has a reason to stay in that business longer term and ensure that, that debt gets paid back. So what does that actually mean? When we look at the fourth quarter of last year, this is all data I pulled from BizBuySell, which is they recognize themselves as the largest online marketplace for buying and selling businesses. They have roughly 65,000 listings a year on that site, not all of which sell. But when we look at the landscape of last year, which has not really gotten any better, we can see you can look at the closed sales in the fourth quarter of last year. These are excerpts I did from a presentation from Northern California, which is why you're not seeing anything there for Central California. But you saw that in Sacramento, you had about 12 businesses sell in the fourth quarter, and you had 17 in San Jose and about 19 in San Francisco. That's the number that actually sold, that actually closed escrow. And when you think of the number of folks in those areas and the number of businesses that actually are there, it doesn't sound like a very big number. We can also notice here is that if you just look at the relationships of the bars on asking versus sales price, you can see that, in the Sacramento area, for instance, you're looking at a percent of asking price. They're about a 9% discount to what was asked is what they closed at. So you're not getting like you were having in the hot real estate market where you've got multiple bids on a business. And often it doesn't quite work like that anyway, but you are seeing discounts. And when you look at it compared to the nation, California saw higher discounts as compared to the national average. And a lot of that can be considered, you just look at everything else, the cost of doing business, the expenses in California are much higher. So therefore the uncertainty would be higher. So then that discount would be higher as well. These discounts, as you see them, really are what you could consider risk-based discounts. If someone's looking at a business and sees a risk, then they're going to want to offset that risk by lowering the price. No different than if you were looking at a home and you saw potential problems with plumbing or electrical, and you think you might have to get in there and do a bunch of work. You're probably going to make a lower offer so that you don't overextend yourself. So over to the right at the bottom, price to cash flow. So this is a metric that looks at what was the price of the business compared with how much money was left to the owner. We'll call that seller's discretionary earnings. For you as a business owner, this is whatever's left over for you to spend after you've paid all your bills. This could be profits that you take home. It could also be if you employ any of your family members at above market rates. If you choose to pay your children, say 50 grand a year for a job you could hire someone to do for minimum wage, that's something that you're choosing to take part of your profit and pay a higher amount to an employee. But after looking at all that, you look at what the price to cash flow is. You're seeing that the national average is about 2.53, and in California we're seeing pretty big discounts to that. So the multiples were lower here, and again, this is in the fourth quarter. So on top of that complication, where you see that these various risks, economic risk, policy risk, you have another risk as well. That's the elephant in the room, which is that roughly half of business owners in the United States right now are over the age of 55. They control, a few million businesses that employ about 25 million people, and they represent about $10 trillion in enterprise value. The youngest of this group will be of the baby boomers will be 65 in 2030. And all will need to exit or sell at some point. So if you think about that, you have a whole concentrated group of people that are going to be looking to get out of the business or be forced out of their business due to death, incapacitation, or other reasons in a relatively short period of time. So think about that in the scope of supply and demand. You're going to have a lot of supply on the market in that concentrated period of time, which means potential buyers are able to be much more selective. They're going to have a lot more choices, much like when people were looking at houses in the hot housing market. People were making multiple offers above the asking price because there were no houses available. But when you've got a slow housing market, the houses sit on the market for long periods of time, the prices continue to drop because there's a lot of inventory and not enough buyers. And that's, a dynamic that you're going to begin to see occur to the point that there very well may not be enough third-party buyers for the number of businesses that are going to be available in the market over the next 10 years. So as a consequence, you're going to, many folks are going to have to consider other means of exiting their business than they may have originally thought of doing. So you're selling. The question is anybody buying? And the unfortunate answer to this is that history is not on your side. By the numbers, 8 in 10 businesses listed for sale go out of business in the process. Now, this includes businesses that have been around for 20, 30 years, or maybe a multi-generational business. I noticed that one of your local multi-generational businesses was mentioned today in Kelly's presentation that looked at transition to another generation of the family. The fact of the matter is that people are really good about figuring out and making their business work. The problem is they haven't figured out how to replace themselves. And in most cases, they have not made their business transferable. The business works just fine while they're there, but if they were to leave, it probably won't operate with them no longer there. I liken this to an airplane pilot. You've got someone who's flying the airplane, and that plane's going to work really well while they're in the cockpit. If they're running out of fuel, that pilot's got a couple of choices. They can go down with the plane, or they can go out with the parachute and possibly survive. But one way or the other, that plane's eventually coming out of the sky, absent, someone coming up and refueling the plane. It's no different when you're in business. If there is no means to transition what you do to someone else, then you are the business. And that creates a challenge in being able to sell it to somebody else. And as a result, the proof in the pudding is that 8 in 10 businesses listed for sale go out of business. Of those that do sell, 1/2 have to make concessions in price and terms in order to make it happen. Businesses often represent up to 95% of an owner's net worth, which means all of the work that you put into this business with the hope that, while it's providing a lifestyle for you at present, the very time that you actually need the money to provide for you when you're no longer working, if 95% of it's in the business and it's not transferable, then you can be in a pretty tough situation when you end up leaving that business. And sellers are most often unaware of what they need in after-tax proceeds to meet their long-term financial needs. What I mean by that is, it's one thing to say your business is worth $1 million. It's quite another thing how much you get to keep out of that $1 million. And then the other piece is, do you actually know what you need to meet your income needs once you're no longer in business? How much money do you need in the bank along with other income sources to replace the income source that was your business? Now, by the causes of why businesses fail near the time of exit is unreasonable expectation of value. There was a survey of owners, and one of the questions had to do with if they'd had their business valued in the last 3 years. 44% said that they had, but of those 44%, 2/3 indicated that it was themselves or their partner that had valued the business. They didn't seek someone to do that for them. And the standard deviation, or the amount above or below the actual value that a self-valuation is off, is roughly 60%. So if somebody has $1 million business, that means that they may be valuing it themselves at $1.6 million, and they would be, people coming in offering $1 million, they're not going to be inclined likely to want to sell the business for that. They may not be able to afford to sell it for that. So they have unreasonable expectations of value. Another cause is the business is completely reliant on the owner and or another key employee or employees. A buyer looking at that business is going to say, great, how am I going to operate it when this person is no longer here, or these folks are no longer here? I've bought a shell of a business and I walk in and I don't know how to run it. I don't have the relationships with the customers. I don't have systems, processes, and procedures. I don't have brand recognition. And effectively, it's going to be on me. I don't get to benefit from the heavy lifting that owner had done. The reason that's important is I want you to think about what a buyer's buying. People can romanticize that I've got the best widget, or I've got the best reputation of the business, and that's why it's worth buying, and this and not the other. A buyer might say, I really want to be in that market, or I really want to be in that industry. But what it really comes down to, what they're buying is the future earning potential of your business. And the premium or a discount that they're going to be willing to pay for that business is going to be relative to the amount of risk they perceive compared to buying it from scratch. The fact of the matter is, you as a business owner have done the heavy lifting. You took the risks. You went out and came up with your concept. You took the risk to get the capital to start the business. You had to find your customers. You had to find your suppliers. Your working capital had to last long enough for you to build a reputation in your community to continue getting your customers back. Someone going into business has to do all of that themselves. And while we see a lot of focus in the economic development arena around new business starts and startups, the fact of that matter is that 9 in 10 startups go out of business within the first 15 years. So acquiring a business is a much lower risk way to go into business for somebody. And if you have a business that you have done those things, you've built your brand, you've documented your systems, policies, and procedures, you've got a good staff that's going to be there when you leave, and they're not going to leave with you, a potential buyer is going to look at that as risk reduction compared to starting from scratch. Now it becomes attractive to the buy of the business. And the better and more complete job you've done in that respect, the more likely you're going to be the one that is acquired compared to one of your competitors. Another cause is the incapacity or death of a current owner. I have this happen, unfortunately, quite frequently. Most business owners, over half, have not taken one step in preparing for their eventual exit. And when asked why, 66% of those responded because they had no idea where to begin. So imagine you are in your mid-50s, your mid-60s, and a health concern comes up that makes you unable to continue to do your business. Or heaven forbid, you pass away and your families or employees are now having to try to figure out how to run the business. If you haven't documented, if you haven't done a brain dump of what makes your business tick, it's going to be very difficult to move that business as a transaction to someone else who can simply step in and take it over. And you wind up in a situation where it could be a liquidation or a fire sale. Inadequate preparation for due diligence is another cause. When someone comes to look at your business, they're going to be looking at your financials. They're going to want to see what contracts you have for recurring revenue. They're going to see what kind of customer concentration, the better prepared you are for that when they have a question that you're able to answer, because the buyer's questions are going to either be coming from investors who this is what they do, or they're going to be coming from lenders who are assessing the risk of making the loan to that buyer. So that potential buyer has some experts on their team that they didn't necessarily just go hire for themselves. They're the people they're looking to secure capital from, who are looking to protect their investment or their debt. Lifestyle business practices impacting current value. Any of you, we don't have you all on camera, but you can to yourself raise your hand if this applies to you. If you had a job before you owned your business, and at the end of the year, what would we do? We'd get our W-2s and we'd make all the deductions we can to try to reduce the amount of taxes that we have to pay. If you do that as a business owner, you're what's called a lifestyle business. You're trying to minimize the amount of taxes that you pay to maximize the amount of income that you take home. The problem is that if we look back at the multiple of cash flow that businesses were, and we look at that $2 or that 2.53, that was the national average. Well, that means that for every dollar you deduct in your business, you're reducing your cash flow by $1, therefore reducing the value of your business by $2.53. So if you come back and say, I got it so reduced that I only show that I had $1,000 in earnings. Well, congratulations, your business is, could be considered worth $2,530 if that was the appropriate multiple. So if you haven't worked with your accountant to and let them know that you're looking to sell in the next several years, then they wouldn't have been able to give you the guidance that you need to start looking at your deduction strategies. And then finally, the business is unattractive to potential buyers, and that could come with a number of causes. Having a lot of dead inventory, having toxic culture, having high turnover in the business, being in an industry that has a lot of regulatory or obsolescence risk. Maybe there are some geographical shifts that are seeing a net flow out of an area that make it, of an area that maybe doesn't have a large population anyway. So there are a number of things that could influence how attractive that business would be. So we learn from those things. One thing is meet with your financial advisor. If you don't have one, talk to someone that you trust that's done well for themselves. It could be a family member. It could be another professional you work with. It could be your attorney or your accountant. But we meet with your financial advisor to get what's called a financial needs analysis. What that financial needs analysis does is it helps to identify the amount of income, a combination of income and assets that you would need to meet your long-term financial needs adjusted for inflation. So the algebra for that is, what do you need to meet your long-term financial needs minus what do you have not including your business? The gap in between is what you need to realize in net proceeds after tax in order to meet your long-term needs. That helps you really to start to figure out what you need to sell your business for. It gives you a starting point. Next, meet with your accountant. Explain to them that you're interested in selling your business so that they can advise you on any changes you need to make from a tax standpoint to both improve the value of your business and maximize what you get to keep when you do sell. Next, obtain an opinion of value. This will provide you with an understanding not only of the value of your business, but also with what needs there are in the way of insurance to mitigate the impact of any potential death or disability. If you're an owner and you were to become disabled, there are some things that will have to happen to keep that business afloat and continue to support your family. So there are different insurances that can be put in place to mitigate the income risk and the cash flow risk that comes from a disability. There's also, if there are partners, is there life insurance that needs to be put in place to secure the buyout of that partner's estate if someone were to pass. And then finally, obtain a value gap analysis. And what this does is it will help you to prioritize what action items you can take that will improve the value of your business as well as its ease of operation. So I talked before about premiums and discounts due to perceived risk. When I do these assessments with my clients, we go through a deep dive, for clients that have engaged me, it's over 300 questions, and we're really looking at the overall operation of the business at a very deep level and identifying those things that represent a risk to the business and what the value of that risk is. In other words, what the value of fixing it is. And then we prioritize by, I'll call it bang for the buck. You look at, okay, well, this thing, we could fix it, and we might see ourselves pick up another $250,000 in value. Well, if there's something else that would take just as much work and would only get us a $10,000 improvement, we'd probably prioritize the one that's $250,000. So by getting that value gap analysis, you're able to then compare that with your opinion of value so that you can say, okay, well, if I went out in 3 years, the business is worth $500,000 and I need it to be worth $1 million. I need to, is there enough of a value gap to fix? And is that possible within the next 3 years? Effectively, are we able to grow at 24% a year? So it really takes it from being this mysterious, I don't know how to figure this out, to it's very methodical. And the great thing is you don't have to remember all this because SBDC has folks available, and they can engage me for assistance in these areas for you to kind of help be your guide, if you will, through that, and help connect you with the different resources that you would need. Then when you're ready, talk with a business broker or M&A advisor. Business sales are complicated transactions that benefit from the help of an experienced professional. Think about buying or selling a house and the ream of paperwork that you have to deal with there, with disclosures and all of that. And then you've got your loan package, and then you've got dealing with title and escrow. Well, with business, there's a whole separate set of issues. First, this business is your life, your livelihood. You might view it as your baby, and it's very emotional. So now you've got to continue running your business like you own it, because you own it until you don't, and you need to maintain the value. Now, if every day you've got people calling you interested in your business and trying to lowball you on offers, that can be pretty emotional. It could affect, your mindset. It can affect the performance of the business and all those things. Not only that, there's a lot more complexity with the sale of that business. So having a broker or an advisor that has some experience in that area helps you to miss a lot of the pitfalls, and also helps to insulate you from, a whole bunch of people tire kicking, and their job is to kind of vet these various folks coming through, so that the only ones you wind up talking to or having to engage or provide information to are those that are ready, willing, and able to purchase that business. They are able to help you understand what trends are happening in your industry, how they might affect value. They can provide an opinion of value and give guidance on an effective listing price. They will also help to develop and execute a marketing strategy for the sale of your business. What you don't want is a situation where people just hang the listing and wait for people to call. In working with a broker, particularly one who's got experience in your particular industry and your geography, if they've sold a business like yours before that had a number of interested parties, well, only one of them got to buy the business. So now they may have a potential list of buyers that might already be interested in your business. And so that makes it a lot easier than you going out and just, putting up a classified out on Biz by Sell for sale by owner. Now, we talked about the fact that third-party sales, selling your business is what most people think about. But there are other types of transactions depending on the objectives of somebody when they're looking to get out. Like for a family business, that's something where you're looking, someone's looking at legacy. They're looking at wanting to continue the history and the values of their family and be able to pass that on for future generational wealth. The pros of that is you get to control your legacy, and you get to have generational wealth that secures the futures of your future generations. If it's a well-run business, it insulates your family from some of the external forces that affect other businesses, because the more generations that you're around, the more established and solid your business is, the less likely to fail. I will tell you that family businesses, only about 70%, where we have 80% failure rate of businesses to sell, we have a 70% failure rate of family businesses to move to the next generation. And that's per generation. So by generation 4, there are only 3% of businesses left from an original 100 family businesses. But for those that are successful at it, you know, you've got long-term security that you're able to project in the future. The cons are that future generations aren't prepared, just as you're not prepared for yourself, someone who's a third-party sale. Oftentimes, you're going to bring in Sally or Junior to run the business, and they don't have adequate experience, and there hasn't been adequate communication with key employees to ensure that they would want to stay and ensure the security of the security of the family members' ability to grow into their roles. Often this lack of communication drives resentment in those key employees, and they leave and go to competitors or maybe even become a competitor. And then finally, there's family contention. Some family businesses put into place something I recommend, which is called a family constitution. If you've got, say, a husband and wife that found a business, they've got their set of values and business philosophy and everything that they've been working on through their career. But when it goes to generation 2, and let's say there's 2 kids, well, they may have different opinions. And then you go to the next generation and maybe there's 4. Now you've got a whole bunch of people with potentially different opinions. So you can wind up with contention as the generations go on. Having a family constitution can help with that, because basically you're laying out the law through that document. But what about in the current generation? You still have to be able to have, say, Thanksgiving dinner together, right? A lot of people avoid the conversation with their kids because it's uncomfortable to tell one why they're leaving the other one in charge. And so there could be that contention, and it's avoided, and that procrastination. You know, the longer you wait, the more you're reducing the chance of a successful transition. A third-party sale, you've got a potential for multiple offers, and you have limited post-sale involvement if you're not carrying the financing for it. The cons are negotiations. Those can be stressful. And sometimes the buyer's unable to perform. And if you're working with a broker or someone, likely they'll have figured that out before you've gotten too far down the road. But I've seen many times where people have gone down the road with someone only to find and pass on other buyers, only to find out these folks couldn't even get the financing they needed to complete the deal. Another factor affecting third-party sales, as I mentioned, is that there are going to be many, many more businesses on the market as years come. And you may find that the pool of potential buyers is a lot more competitive. Employee management buyout, there's a bankability advantage potential there. Let's say that you've got a manager who's been with you for a long time, and you've got a great company that's bankable. If a bank is looking at 2 potential buyers, one is from upstate New York and has never been in California, and the other buyer is your manager. They've got equal industry experience, they've got equal credit, all of those things going for them. They're likely going to look at your manager more favorably because they say, well, we already see that this business is bankable, and this manager is part of the reason that it's bankable. So there could be a bankability advantage with that. Some of the cons are that good employees don't always make for good business people. And we see many cases where an employee takes over the business. Maybe there's some owner financing. And when the employee begins to fail, the selling owner has to step back in and repossess the business. And now they're back to work long after they had already retired potentially, and their choices are go in and save the business, or just, write off that asset and lose that money that was meant to secure your future. And then one that there's been more talk about lately, still isn't super broadly used, but has a lot of potential, are employee ownership through employee stock ownership plans, the ESOP, worker cooperatives, and employee ownership trusts. Some of the pros are that you get to control legacy. For instance, if you're in a rural community and you're maybe one of the major employers in the area, and you want to make sure that that business stays put, selling to a third party, you have no control over that. But through employee ownership, you're ensuring not only that those employees have a job, but they're also benefiting from having helped you to build that business. It rewards employees, it protects jobs, it reduces turnover by a factor of 3. Employee owners have, like I said, it's, you've got 300% greater turnover in non-employee owned companies. And there can be some significant tax benefits depending on your business structure, both in ESOPs and cooperatives. The cons are employee ownership structures can be costly and complex. You figure that it can cost you $250,000 to $300,000 to set up an ESOP. And you have to have a large enough and diverse enough from an age standpoint workforce to support that structure. So it's not feasible for all businesses. You'll see that there are under 10,000 ESOPs in the whole country. And of that, there are like 900 of them are in California. So even though they've been around for a long time, they're not super widely used, but there is a lot of promise, particularly because in the last few years, we had in 2018, the federal government on the federal level put in the Employee Ownership Act, the Main Street Employee Ownership Act, which was aimed at improving access to employee ownership. And in the last year, we had the California Employee Ownership Act that was passed. Once it goes through appropriations, that stands to provide some grants that are pretty significant to help pay for the feasibility studies that are necessary when someone's looking at employee ownership. So there are some things coming along the pike that will help to make employee ownership more accessible. And the employee ownership could be, as we talk about the glut of potential businesses on the market, I think you're going to find that employee ownership is going to play a very big role in helping to ensure that these businesses continue on to a life providing financial security for future generations. Now, before we go to questions, I want to say, when we go back to the economic development, as I mentioned, 8 in 10 businesses listed for sale go out of business in the process. 7 of 10 family businesses don't make it to the next generation. 9 of 10 business startups are out of business within the first 15 years. And the challenge is you've got some really great businesses in your community. You being on here and taking the time to be on these webinars, you probably own some of them. And the thing is that it could be the one thing that keeps that business from moving forward is that you simply didn't prepare for your exit. Well, let's imagine that you've got 5 employees in your business. Let's say you've got a machine shop. You've got 5 employees. If I'm looking to start a business, I could see if it was a technology that didn't already exist and I came up with it, it would make sense to start something from scratch. Or if I had a service that hadn't been available, I could see that being a startup. Or the kind of business that I want to do isn't already in the area. Okay, great, we need a sporting goods store. There isn't one here. Okay, I'm gonna have to start from scratch. But if, let's say you want to start a machine, or I want to start a machine shop, I'm gonna have to make capital investment in equipment. I'm gonna have to take out debt. And that debt's gonna be likely in the form of SBA financing, which you can't discharge in a bankruptcy. So I'm putting myself in financial risk to do that. Which it's worth it. I want to take a chance on myself. But if I look at somebody who's got a 30-year-old machine shop that already has customers, already has cash flow, well, it would be a lot less risky for me to buy that business. And you get to sell your business because you're selling them the fact that they don't have to reinvent the wheel. Now, what it does for the community from an economic development, this is, I'm on my soapbox a little bit, what they're really missing in economic development is a startup maybe starts up with one employee, and they've got to grow into having more employees. And if you aren't able to sell your business and it closes, you've got 5 people now that are going on the unemployment line, and you might even need some financial assistance because 95% of your net worth was tied up in your business. Wouldn't it make more sense from an economic development standpoint to keep those jobs that already exist, that are already paying taxes? The business is already paying taxes and is already providing a trusted source of goods and services to your community. So you being able to prepare your business for sale isn't just good for you and your family. It's good for the community, and it's good for your customers. And so it's definitely a worthwhile venture to go forward. And it's that economic impact certainly is a reason that SBDC, provides services like mine to help with that as well. So with that, I'd love to open it up for any questions if there's time.
Well, Michael, I don't see any questions at this time. We have a very shy audience this week. So I guess what we can do is we can wrap up. And if you have any question, you can send me the email. Again, Michael is a great resource and is available for a lot of different businesses. And we can we work with them at our small business development centers in Central California as well. So that is a great resource. And I know he's working with a few people that we know already. So one-on-one, I'm sure you can accomplish a lot more than just through a webinar. So any final comments, Michael?
I would just say that the best thing you can do is start with the end in mind. It can seem overwhelming. This is why I hear from people a lot. If you're going to eat an elephant, you can only eat it one bite at a time. The biggest thing is take the first step, make that call to Kelly. And like I said, I'm glad to answer any questions as possible. And also, any of you that are attending can go to my website, bizleavable.com. And there is actually an assessment on there. It's a short form assessment that you can go through. And it takes a look at your business from a number of different value drivers. And it'll give you a high level idea of where to start making some improvements in your business when you go to exit. And it's at no cost.
Well, fantastic stuff. Thank you so much for joining us this week, Michael. Big thank you to Dr. Mark Evans also for his participation as our resident economist. We will be back next week with webinar number 280, and it'll be on pricing your small business. So for Michael Balstad, I'm Kelly Bearden. Have a great day, everybody. Goodbye, everyone.
Thanks, everyone. Bye-bye.